In my last video, which I recorded on the 17th of March, US equity markets had fallen by 10% since their February peak. Now, as this chart shows, since then, the only thing markets have cared about is trade policy, particularly since Liberation Day, Trump's term for the unveiling of an enormous set of enormous tariffs set far higher than he discussed on the campaign trail and far higher than financial forecasters, including us, had been expecting. That, along with aggressive retaliation from China, took the US equity market correction from 10% to 19%. FTSE 100 has fallen by less 13% peak to trough, and it's up a percent since then. But there is more to investing than trade policy, right? And it's important not to lose sight of that. 2025 may or may not be the year that global trade patterns are changed forever. Is anyone seriously suggesting that it's going to be the year that companies will forever cease to generate free cash flow to shareholders? No. Business models adjust, market pricing adjusts, and there may be more of an adjustment still to come. We'll get to that later, but pretty soon the world adapts. Take 2018, 2022, or 2020. Not that long ago, and in each of those years, we had a bigger peak to trough fall than the 19% we've seen in the US markets to date. And in two of those years, we had the truly staggering disruptions of the pandemic and then the permanent remapping of global energy supplies following the Ukraine war. All economic activity is energy transformed, after all. Yet the global equity market is still double its 2018 value. The long-term resilience of financial markets is really important to bear in mind. In 92% of rolling 10-year periods since the 1960s, equity returns have been positive, with a remarkably small amount of variation. Even over rolling 3-year periods, equity returns have been positive 80% of the time. The median return over the 12 months following a 10% correction is 15%. The exceptions to these are almost always accompanied by a recession. Recessions temporarily stop markets from functioning as rational long-term earnings discounting machines. That's why when markets do fall by 10 to 20% in short order, which isn't uncommon, investors must carefully assess for the kinds of systemic stress that can turn a correction into a bear market, and moreover a short-lived, event-driven bear market, such as the one in 2022, into a more protracted cyclical bear market, or worse, a financial crisis. Only 1 in 5 corrections turn into bear markets, and these almost always entail an economic or earnings recession. So we survey banking stress first of all. It's currently very low. At the time of recording, there has been no marked change in money market spreads or an alarming leap in bank capital costs or the various swap rates that indicate that banks are worried about lending to other financial firms. Banks don't seem to be relying on the Federal Reserve to provide them with emergency liquidity. Lots of people seem to be invoking the Smoot-Hawley tariffs of the 1930s as a precedent for today, but those tariffs occurred during the almightiest banking crisis the world has arguably ever seen, which the gold standard made it very hard for central banks to respond to. Those tariffs didn't cause the Great Depression, they made it a little bit worse. Today there is no banking crisis, the gold standard is long gone. And as an economic historian, I beg commentators to stop referencing the 1930s as a useful precedent. We also look at broader debt market stress. There have been very limited moves in corporate borrowing costs, even in less secure debt more sensitive to bankruptcy risk. This is an important contagion channel, and it's comforting to see it stay low. It's also worth noting that we've had more than 15 years of emergency policy measures designed to combat various crises, and most of those have remained and become permanent backstops. In short, the world has never been better set up institutionally to contain banking and debt market risks should they arise. Finally, we survey recession risk. This week, our Asset Allocation Committee reaffirmed our view change made just after Liberation Day that the US is now at 45% odds of a recession within the next 12 months. Now, the direct impact on the US economy from tariffs per se does not unequivocally get the US to recession. Tariffs are essentially a tax increase, and those announced correspond to a hike probably equivalent to more than 2 percentage points of US GDP, and that's potentially the biggest tax hike since the 1960s. It's hard to say how much is actually passed through to US buyers, of course. In practice, some or even all of that may be recycled into cutting other taxes, as Trump has suggested in the last couple of days. And we should note that the Senate passed a resolution at the weekend that paves the way for some massive tax cuts. although there's a lot of legislating to get through before that turns into law. Concerns about ripple effects from tariffs and other policies has tanked consumer sentiment, but since 2016 there has been no statistically significant relationship between consumer sentiment and actual consumption. Part of that is due to the wealthiest households becoming so wealthy that their continued spending can offset temporary declines in real wages for the less wealthy majority. The richest quintile own a record 73% of household wealth in the States. Accordingly, a rapid decline in wealth could cause a big temporary negative effect on their spending, but we're probably talking about a 30% peak to trough fall or more in equities before that kicks in. It's also important to note that the consumer is being helped by oil prices falling to a 4-year low at the moment. Now, the key channel to watch is business investment and the impact policy uncertainty is having on delaying or cancelling business investment plans. Intelligence from corporate boardrooms is that they are somewhat dumbstruck by the scale of the tariffs and yearn for clarity on how long they may be around. Remember that there have been a few US recessions where a contraction in business investment alone is enough to cause a recession even when household consumption doesn't actually fall. But the key takeaway is that we do not yet assess the risk of recession to be more likely than not. That's important to bear in mind. It is all too easy to focus relentlessly on the risk and not enough on the opportunity. So to sum up, recent sell-offs are no more pronounced than in 2018, 2020 and 2022, periods of profound economic disruption. The risk of a financial crisis that takes years to recover from is very low. We believe there is a 45% chance of a recession. If a recession gets clearly priced by markets, that's likely a buying opportunity. We are long-term investors looking after the long-term financial well-being of our clients. We are laser focused on the risks. We have a plan for capitalizing on opportunity. Trade policy is far from being the main driver of markets over the long term, and markets have proven themselves time and again to be resilient. Thank you very much for listening.